Howdy, Jacob here. Today we're looking at Lincoln Electric Holdings in the machinery industry. 14.4 billion market cap, slightly higher enterprise value. Been around since 1895, headquartered in Cleveland, Ohio. We're not looking at immense growth here as suspected from a company founded before 1900. But the good news is we are still seeing some growth, definitely 2.8 billion in 2014 up to 4.2 billion last year, and then both margins up a couple percentage points, which is very impressive, as well as return on invested capital consistently above in the high teens, low 20s, which is very impressive. Great return on that investment. Their balance sheet has 394 million cash on hand with just 1.1 billion long-term debt. So that 1.1 billion in long-term debt versus, let's say, 350 million 5-year average free cash flow is about a little over 3 years. But again, you have that 384 million cash. So we're looking at net debt, probably 2.5, 2 years to pay off. No concern there from a balance sheet perspective. So not concerned by that debt. And then for use of cash flow, very heavy on the acquisition side. We see that if we were to look on an average basis, they're probably paying maybe 25% for acquisitions, 50% for share repurchases, and then the remaining on a dividend. And it looks like they've actually increased debt more than not in the last 5 years. But again, like I said, the debt figure is not very concerning based on their average free cash flow. So use of cash is, as you would expect for an older company, a bit on the dividend side and then making acquisitions. But it is interesting and positive to see that they are buying back a lot of shares. Hopefully, they're buying back cheap shares, but it looks like they're just doing the dollar cost average method, where really just every year they're buying back 50 to 75% of their free cash flow or they're using 50% plus of free cash flow to buy back shares. So they're buying back less in aggregate, um, less. There's less share repurchases now than there was 10 years ago by about 40%, but it's still buying back shares. So again, if those are cheap shares, it's great. Even if they're not cheap shares, they can be used to increase earnings per share, absolutely. But you got to remember that you don't just want them to be buying back shares willy nilly, because their use of cash is why you're investing into this business. You're buying into the business or buying into this company for their use of free cash flow and how they can distribute it back to you as the owner. And whether that be through dividends, so physically giving you the money back, or increasing the actual business itself and making it worth more through, if you buy back shares, then your share amount is worth more, all else equal. And then if they improve the business, which is what we want them to be doing in this screener, we're looking at high returns on invested capital. And here we're seeing high teens, low 20%. If they can actually get returns on those historical rates of return prospectively, then we absolutely want them to be doing that. If they can find expenditure, or they can find things to invest at these types of returns, you definitely want them to be doing that. And so that's where, um, a company founded in 1892 might not have the most. They might be peaked out or near peaked out in their relative industry. And so it might make the most sense to just pay a dividend or make acquisitions that are making the business more efficient. But if they do find those rates of returns, we absolutely want them to be going into those things. So let's start doing some assumptions here. On the margin side, it's pretty close. Let's go 10, 11. Revenue side, I'm not going to see a whole lot of revenue growth, I prospect, even though the last 3 years have looked absolutely astounding. I'll probably generalize it to a more even playing field of maybe 3%. And then I'll say that pretty average P and price to free cash flow, based on the fact that the growth might not be as high as the average company, but I do think that they do have, um, you do see moats through high returns on invested capital businesses as well as increased margins. And we are seeing that here. So I'll put a tiniest premium on P and price to free cash flow based on their growth rate. And then for share change, let's say they buy back 1.5% of shares at their current market price. That'd be about 200 million, and they've been doing that in the past. So I think I'm comfortable there. Dividend is paying out less than half, and with them buying back shares too, the aggregate dividend payment is not as high, so they can increase this even more. Let's say 5% or so. So this is saying that the business is increasing 3%, they're buying back 1.5%. Increasing dividend at 5% is essentially almost flat, keeping the aggregate payout for the dividend flat. But that still gets us to a price that needs to fall quite a bit. And again, that makes sense. Just looking at the PE, seeing 26, we're saying it's 15, and their growth rate is well below the discount rate that I'm looking for here. Again, every person's different. The way you should invest to be based on your current situation. But for me, I'm just looking for great returns, and I'm willing to wait out companies' stock prices falling more for businesses that I like. And I do think that this is a good business. Definitely not one of the best ones I've seen in the screener, but absolutely a good business based off the numbers. And so something I'd want to own just at the right price, and it doesn't look like we're there yet. So thank you, and have a great rest of your day.